Hello, everyone. Happy Saturday. Welcome to StockCharts TV. Thank you so much for hanging in with us as we launch this Charting the Second Half Market Outlook panel. This is the culmination of a week-long event on StockCharts TV where we focus on looking forward. Think about how the first 6 months have evolved, 6+ months, and focus on the second half of the year. We're at such a pivotal time for so many reasons, and when I'm thinking about a panel with 4 great panelists, my cup runneth over with things to ask everyone. And we apologize for adjusting the start time a little bit. We were getting all the technology in order, but I tell you what, it made me feel better and should make you feel better because I got to hear the side conversation happening with our 4 panelists as we were waiting to get the tech set up. And I tell you what, I wish we could just have an event like that every Saturday, hearing 4 guys like this chatting about what they're seeing and what they're thinking, because I was making rapid notes about all the different insights I was starting to pick up a little bit. Here's our plan for the next hour or so. What we're going to do is introduce each of our 4 panelists one at a time. I'll share with you just very quickly who they are. On StockCharts.com, we have so much more information, a lot of their great content that they've contributed to the website. But then we're going to have each of them share one chart, just give us a quick insight on what's top of mind as they think about the second half of the year. Then what we're going to do is have a Q&A that I will start, and I'm going to ask each of them a question to get some conversation going, approaching some of the different key themes about leadership rotation, about asset allocation, about the FANG names potentially rolling over, the value trade, is that returning, gold and commodities and the rallying. We'll try to hit on as much as we can, and then we're going to open it up for you. There's a Q&A panel right on the StockCharts TV page on the right side of the video. Put in a question now, all as we're talking, and we're going to get to as many of those questions as we can. We're going to finish with a lightning round, and I have some questions prepared to have each of them give us a quick hit. And by the end of the hour, I think you will have a lot of good ideas to dig into as you prepare for the second half of the year. Gentlemen, thank you so much for giving us some time on a Saturday. I know we're all, taking time out of personal events and family time to be together, but thank you for giving StockCharts TV some of your insights today. Really appreciate it. So listen, what I would like to do is just hit each of you one at a time. We're going to start with John Kosar. I'm going to just briefly introduce you and ask you to share your chart that you shared ahead of time, and we'll start to go from there. So John, we're going to start with you. John's the Chief Market Strategist at Asbury Research. Not too long ago, launched a registered investment advisor, an RIA, called Asbury Investment Management, and he is one of our newest StockCharts contributors. He's actually done your Daily 5 a number of times for us. John, thanks so much for joining us this morning. We appreciate it.
Oh, happy to be here.
So, John, you had sent a chart which was really compelling. It's a great place to start because it's looking at the S&P 500, but actually looking at the ETF for some information, I think, about the supply and demand. Tell us what you brought with you with the first chart here.
Sure. The chart shows the daily asset flow in the spiders. The chart goes back several months. And what it shows is that period during June, where the market was, or the S&P 500 was basically ping-ponging back and forth between 3,000 and 3,200, those flows went flat. And the way we measure them is our tactical time period here is 21 business days. It's a month. So we look at all of our tools that we think are tactical through that same lens. So now you can look at 10 different things with the same perspective on them. Those flows started to expand again on July the 2nd, and they've accelerated quite a bit over the past week or so. So even though we technically haven't broken out yet, that level is around 3230 that we're trying to get through, and we closed right on Friday. The fact that you're seeing this flush of money go back into the spiders, it's trend fuel. So that suggests to me that we're going to get through that 3230 area. And if we do get through there, then we're looking at the all-time highs. There's really nothing else to stop the market in terms of resistance after we get through there. So you can just kind of see that flatness now. The red on the right in the lower panel, you see from June 24th to July 1st, it actually dipped underneath. The total net assets went underneath the 21-day moving average. That's when the market was struggling. That's when the S&P 500 was struggling. It was trying to get through that level, or it was trying to hold that 3,000 level. It did, and then right at the beginning of the month, it was kind of like the cavalry came in. You saw those assets coming back in, and they spiked up. So this bodes well for the market breaking out of its recent range and moving higher over the near term.
It's a really interesting chart, and what I love about it, it relates the price, which obviously so many people are laser focused on and focusing on this key resistance here, just above 3,200, 3,230 or so. And the fact that the flows have started to really come in here is compelling. I'd love to just ask, I mean, what would tell you that things are starting to get negative? For you, is it more about the price violating a key support level? Is it more about the assets starting to rotate lower, a divergence of sorts? Like what would be your tell on this sort of chart to tell you things are not as attractive as they may appear at this point?
With this particular indicator, it's pretty immediate. I think it's cause and effect because those flows going in and flows coming out are what actually moves those index or moves those assets. So one thing I would look at is if we, a week or two down the road, if we're unable to take that old peak out that you could see that we made right at the beginning of June down low in the net assets and the total net assets, there we go. Right there, if we struggle to get up above there, one thing that is a little nuance of this data that I have noticed is there are actual breakouts and flows as well. If you go to April 6th to June 23rd there, you'll see right down the total net asset side, you'll see right in there, they were kind of bouncing up against that level. And they were trying to, the assets struggled to make a fresh high. As soon as they did at the back end of May, that's when we got those kind of retro rockets going. If you go straight up now to the S&P 500 chart, straight up from there, you'll see that move into the highs really happen right after the assets went higher than that April 6th to June 23rd period. So sometimes you could look at those assets, find a resistance level, and when the assets finally push through there, that usually equates to a new thrust in price to higher ground.
Perfect. That's a great take, John. Thanks for that chart. That's a great place to start. I want to move on to Julius de Kempenaer. Julius, good evening, my friend, and thanks for joining us so late for you. I appreciate it.
Yeah, no problem, Dave. My pleasure.
So Julius, the creator of the relative rotation graphs, founder of RRG Research, he hosts Sector Spotlight here on StockCharts TV, and I know in my show, The Final Bar, I often point people to your show, Julius, to get a better sense of this visualization that I've used for a number of years. So I was very happy that you're starting us with this look at sectors and some other things. Tell us what the RRG is telling you here.
Yeah, the RRG that I want to use for this occasion is basically the RRG for US sectors, and I have stripped away a few that are way out, like most prominently the energy sector, because that is way up inside the improving quadrant, but already rolling down. So I think that will continue its very weak stint of relative strength in the next few months. So I'll leave that aside. But what I'll see here is, you see in the green, you see these growth sectors like discretionary, communication services, tech, that are all rolling over. And inside the improving, you see financials and industrials that are starting to pick up. And inside the lagging quadrant, you see utilities and staples to pick up. I have added the value and growth ETFs. So they're almost at the 100 level on the momentum scale. So there is the little yellow one exactly there, yes. That's the growth ETF. And on the left-hand side, you see value. And they are rotating in opposite directions. And that is a bit of a, sort of a warning signal, I guess, that the big run in growth has at least temporarily come to an end. And that coincides with the rollover that we see in those sectors, communications, tech, and discretionary. And the volume segment, the value segment has started to pick up. So, I guess industrials, financials there. My take on this, and I also put in a IEV, that's European stocks, that's in the improving quadrant, the big one there. That points to an outperformance of European stocks over the US, because S&P is right in the middle, so IEV is heading at the right direction versus the S&P. And I have TLT and BIL. So TLT is the long bonds and BIL are the short bonds. they are now measured against SPY. That's not the best of benchmarks, but I still wanted to put them in because I think that long bonds are pointing to higher prices, which means lower yields. And if you look at that chart, that TLT chart in isolation, that is, well, either close to or already breaking out to the upside. And that'll be, that'll be a positive thing for stocks. So my take for the next 6 months is that we will see value taking over from growth, at least for a short period of time. We'll see bonds rising, which will be good for stocks. And we will see some defensive sectors like industrials, financial, well, financials not really, but utilities and staples picking up. So I don't know, let's call it an educated guess or a little fantasy, is that growth will weaken, value will rise for a short period of time, and during that sort of general market weakness, because these are pointing to general market weakness, I am thinking that financials, industrials, utilities, staples will be able to hold up the S&P at current levels, maybe push it a little bit higher until the big guns come turning around and start picking up momentum again, and that'll be the final push to new highs, driven by these growth sectors and even lower yields.
Julius, that was an awesome take. You hit on about 800 different things with that, and I would love to dig into each one of those much more. But I think what you've hit on very beautifully, and I think the RRG does such a great job of that, is just hitting on the rotation, the leadership rotation that we're potentially seeing right now. I want to get on to our third panelist, Greg Schnell. Greg, thank you for joining us. one chart with many inputs. Well done, Julius. Well done. Greg, thank you for joining us from up north. We appreciate it very much.
Hey, Dave. Yeah.
So Greg is as a longtime StockCharts contributor, a name and a face I think familiar to many of you. He's author of StockCharts For Dummies, founder of GregSchnell.com, and he hosts Market Buzz on StockCharts TV. Also, I heard he's going to be hosting Your Daily 5 coming up this coming week, which is a really good show that a number of our panelists have been a part of. Greg, you're actually hitting on commodities. When I think of commodities, when I think of oil, when I think of gold, when I think of base metals, copper, I immediately want to look at your articles and what you've written, what you've been talking about, because you usually have a good sense of it. Give us a look at copper and what does this mean for the big picture to you?
So copper topped out in 2011 and really has been in an exaggerated decline over a long period of time. So 10 years. And what we saw this week is that copper is starting to break out to new highs above, so new 52-week highs, but more importantly, breaking that 10-year trend line. And this is my working chart, so it's a little messier than an alternative would be to have everything cleaned off. But the one thing I want to show is that many times copper has basically got to the zero level on the PPO and rolled over in momentum, and that just keeps crashing. And what we see down at the bottom this time is we've had the highest spike in 3 or 4 years, going back 2 years, and the last time we saw this was 4 years ago at the end of 2016. So we want to watch copper here for a big breakout, but more importantly, I think this has a big arch to it, and the group, when we talk about energy breaking out, I know a lot of people are talking about liquid energy, so gasoline and diesel and crude oil. But more importantly, I think what I'm starting to see across the copper space, so, and this would be driven by Tesla and NEO, is you're starting to see demand for copper pick up, and that means that in order for these grids in cities to start to keep up with the demand for electric cars, we're going to need a lot more copper. So we're either going to need copper mines and transmission lines, and all of those take a long time to get improved in the world of environmental and NIMBY, not in my backyard. So I think copper's got a big upside demand, and that goes across into the utilities for electric utilities. It's going into alternative power with hydrogen. You'll see Ballard Power and Plug Power and Nikola all starting to rock to the upside. Uranium broke out with copper, or with Cameco breaking out. So I think there's a whole big move into electrical energy development or build out, and a lot of the solar names and renewable energy names are all starting to kick up, including, renewable energy utilities. So I think copper is just one clue, but across the spectrum, there's a whole bunch of stuff just starting to break out to new 52-week highs. I think it's a big area for the second half of the year.
It's such a great chart, and what I appreciate, a number of things, Greg, it's such a long-term chart, which is so helpful. And I know from my time at Fidelity, we focused on copper a lot, just as a good, I think of it a lot like semiconductors, sort of a, when copper's doing well, it just makes you feel good about stability and potential upside and what people are planning for. And when it's struggling, it feels like it's sort of a headwind to growth. It's such a great chart. We're going to come back to so many other themes, Greg, but thank you for sharing that. Our fourth panelist, Grayson Roze. Grayson, the Vice President of Operations for StockCharts.com here in the Seattle area, is the author of Tensile Trading, co-author, and also the author of Trading for Dummies. He's a frequent guest host, pretty much as often as we can ask him very nicely to host stuff on StockCharts TV. He graciously accepts. So Grayson, welcome on as a panelist today. Thank you for joining us.
It's never nice. You guys always force me to do this stuff.
Kicking and screaming, you participate in the panel. But listen, you and Julius win the award for packing as much data into one chart as possible. So points for both of you. But your chart really speaks to, I think, thinking of some of the leadership themes going into where we're at, and I hope looking forward to the second half of the year. Walk us through your chart, would you?
Sure. So I know I cheated here. You said one chart, but I think I put 7 on this one.
That's right.
So,
That's right.
Sorry for that. But I really am. I mean, the point here is I'm thinking about these sort of 3 groups in addition to the S&P 500, all as one. I'm thinking about it sort of collectively and what that signals for the market moving forward. So, Dave, I want to kind of start actually in the middle. We have an S&P 500 that has really gone sort of nowhere for the last 45 days. But within that time, we've sort of topped out around that 32, 35 range, but we've also bounced off the 200-day moving average twice. And so we've been in this pretty clear range-bound pattern moving sideways. Throughout that time, specifically in the last month, if you go back up to the top, what we can see is 3 groups that have been leading higher, that have been outperforming the market and making new highs. So at the top, we have biotechs. Obviously, in the middle of a medical crisis that the world is facing, biotechs have been incredibly strong. But we have biotechs going to new highs. We have semiconductors going to new highs, which is the red line. And like you said, I mean, when you see semiconductors going to new highs, you just sort of feel good. I like that you just said that a minute ago. And then below it, we have something a little more unusual, which is iBuy, which is an online retail ETF. So these are 3 groups that we've been watching throughout 2020 really lead higher. And what's key when I look at these 3 groups is that they're all incredibly offensive names. These are not staples. These are groups that are inherently risky. They're sort of more risk-on trades is how I kind of think of them. And so to see them lead higher, I'm looking at that as a signal about kind of the appetite for risk that's playing out in the market. And when we go down to the bottom, what we can see is not only are these making new highs, but they're also outperforming the S&P 500. So specifically within the last 30 days, we've seen the S&P 500 again just kind of moving sideways, not really going anywhere. But within that last 30 days, we've seen biotech accelerate in outperforming the S&P 500. We've seen semiconductors accelerate in outperforming the S&P 500. And we've seen especially online retail accelerate in outperforming the S&P 500. So when I'm seeing these 3 groups not only going to new highs, but also leading the market and outperforming SPY, I just can't help but think there's an appetite for risk out there. And when we look at sort of where the market's going to go, I think that is a driving force. So I'm definitely watching these 3 groups again, kind of collectively. That's why I got to all of them on the chart here. But together, I think they send a pretty clear message about sort of where people want to be positioned and what the appetite for risk is in the current market.
It's such a great chart, Grayson, and what I love about it is you've hit on at the bottom there. I think when the market rallies, I sort of automatically start to look for warning signs, and it's hard to feel that negative about things when those 3 groups are just continuing to outperform. And the relative strength of semiconductors is an indicator I've used for years, just as a general finger on the pulse of what's happening. We're going to get to so many questions. Grayson, thanks for that chart, guys. This has already been so great, and just from hearing you guys talk, so many questions come to mind. I'd encourage everyone watching, if you have questions you'd like me to ask of the panelists, put them in the Q&A panel now. We're going to get to as many as we can. I have a couple questions I'd like to start with, and then we'll get right to some of the questions you've been sending in there. John, if I could circle back with you first, to be honest, when I think of your work, I immediately think of the Asbury 6, which you and I have talked about before. Sort of, what I like about it, hits on, some different broad thing, breadth, sentiment types of things, supply and demand. I'm curious, when you're looking at, sort of the next level under the hood, not just the S&P, but sort of the next level down, things like breadth and sentiment. In your work, do things feel overextended? Do the breadth and sentiment measures you look at feel supportive of further upside? Where are they at now, and where do you see them headed next?
Really good question. The Asbury 6 are tactical. They are 6 indicators that are readily available. We look at them all through a 21-day lens. So, we're seeing the same thing. We're working in the same time frame. Only one of those has to do with price, and that's the monthly rate of change in the S&P 500. But all 6, or we need 4 of 6 to be positive. We update it every day on our website. They've been positive basically since the very early part of this month. And the first chart that I talked about this morning, it talked about flows. Flows are one of the Asbury 6, the flows in the spider. And that shows conviction. Volume shows urgency, as we know. So you can get little spikes in volume if the market is nervous and chops back and forth, and it's up 31 day and down 40 the next. But when you're looking at asset flows, it shows conviction. People are holding these ideas overnight. They're holding these assets overnight. So it looks to me like the market, or the S&P 500, wants to go through 3,200. If it does, I think it takes us up to the highs. Bigger picture, though, you talked about sentiment. Another chart that we're looking at, or another kind of genre of charts that we're looking at, are some of the sentiment surveys. There's a bunch of different ones out there. And the ones that I'm seeing are showing that if you're looking at this like a baseball game, both of my kids are baseball players, so everything's a baseball game around here. But if you're looking at the move higher from the March lows, it looks like, according to the sentiment metrics and stuff like put to call ratios, it looks like we're in the 8th inning. Sometimes a ball game will go 10 or 11 or 12 innings, so you have to keep that in mind. But generally speaking, it's a 9-inning game. It looks like, from a sentiment standpoint, we're getting close to that time where you should start to see some kind of weakness coming. But again, that's when we rely on the tactical tools, like the Asbury 6. If the Asbury 6 stays positive for another 6 weeks, I'm right there with it. But if we see these warning signals in sentiment, put call ratios, things of that nature, and then our timing tools, our tactical tools start to turn, that's when it's time to start to pull some risk out of the market and start to prepare for some kind of a move down.
It's a great take. I don't know if anyone else wants to weigh in on that, but in particular, when I'm thinking of breadth, one of the challenges, Grayson, you talked about the strength in some of those key groups. I think the question mark a lot of people have had is the lack of participation in small caps and mid caps. That's actually started to change a little bit going into, in recent weeks. And now the question mark is, do those participate, or are we rotating into those names of some sort? What do you guys make of the lack of participation in small caps, but all of a sudden a relative performance that potentially is attractive? How do we think of that?
If I picked up the mic, the big thing for me is looking at the momentum going on in almost all of the different industries, and I still have everything trending higher. Like 97% of them have higher momentum on weekly charts. So I'm having a lot of trouble finding any negativity. Price continues to lead higher. Advanced decline lines are all very supportive. Almost everything I go through, with the exception of put call ratios, which is at a warning extreme, I would just say that, From a breadth perspective, I have nothing telling me to get out of this market. Everything says keep riding the train.
Got it. Further
say-
upside. Anyone disagree with that? Anyone see anything different? Because that's actually a pretty interesting data point.
No, I think breadth has been weak. I mean, especially in the NYSE. I mean, we've seen a bit stronger breadth in, especially in the Nasdaq and the S&P 500 as well. And those are both finally, if we're looking at percentage over the 200-day, those are both finally over 50%, which is good. But we're still seeing, like you mentioned, the sort of the lack of participation in other stocks beyond just the big indexes. So when I'm looking at breadth in the NYSE specifically, percentage above the 200-day, we're still only at 39%, which is getting better. I mean, it's improving, I can say that, but it's still weaker than I'd like to see. I mean, ideally, I'd love to see those breadth numbers all over 50% between the NYSE, the S&P 500, and the Nasdaq. But I mean, it is improving. I will say that, and like Greg is saying, price continuing to go higher. That's the ultimate measure. So it is tough to look at some of these internals, which are, maybe cracks are forming or something like that, but you've still got price going higher. You still got price going higher.
And you guys, I wish everyone watching could have picked up on the coffee talk that was going on while we were getting the tech issues lined up. It was just fun to hear you guys just, comparing notes about things. But that was one of the things that I picked up from a couple of you, just the, price and focusing on the price. And you're right, when you do that, the price keeps going higher. We're in a bull market phase. I mean, that's by definition, right? Julius, you made a comment earlier about European stocks. I think the IEV is one of the items on your rotation. And one of the things we talked about on my show in for a while now is just the weaker dollar environment. And one of the survey questions we asked on StockCharts TV last week was what U.S.-based viewers were doing with their non-U.S. allocation if they were increasing it. And I think it was just about over 50% were either increasing or keeping their international allocation the same, which surprised me in that I feel like it should be much higher because weaker dollar, all of a sudden some of the non-U.S. markets relative to the U.S. have improved so much. In your work, thinking of the rotation of these things, how do you relate what you're seeing outside the U.S. versus inside the U.S.?
Well, there is definitely a rotation going on in favor of foreign stocks. I have an RRG showing a bunch of international market indexes versus the Dow Jones Global, and that shows a ton of markets inside the improving quadrant and heading towards leading, which usually is a good sign because they're picking up both relative strength and relative momentum versus the world. And the S&P is inside the weakening quadrant and moving towards lagging, which is a negative sign. So as for the next few, I think it's going to be weeks, we will see that continuing. The most probably the most notable one is the emerging markets rotation, or the rotation in favor of emerging markets.
Yep.
But also think in terms of Brazil, of Japan, Mexico, Europe. They're all picking up momentum versus the rest of the world. The big question, of course, is whether this is a move that is sustainable enough to continue to beat the US towards the rest of the year. Because the one caveat that I have to make is that they are inside improving, but they are still shifted pretty far to the left, so pretty low on the RS ratio scale. So there is a risk, if you want to call it like that, that they will not make it into leading. So they will roll over and you will have a temporary hiccup of strength outside the US, which will eventually roll over and then the US will pick up again. I mean, if you want to bring it up, there is a predefined group. If you go to the RRG page, there is a predefined group called international markets. So down there, international stock market indexes. Yeah.
There you go.
Take this. Yeah, that one. And then you will see that whole cluster in blue. These are like Brazil, Europe, CNX. That's the Nifty. That's India. So they're all moving there. And then the S&P, which is very close to the benchmark, which is to be expected because the S&P is a big part of the world index. So it will always be a lot closer to the index than the smaller ones that are far out. But it's pretty obvious that there is a rotation going on in favor of foreign markets. And forget about the ones in red over there. They're small. There's a small country there called Canada, TSX, that's moving the other way.
No antagonizing the other panelists, Julius. That's a standard rule. I should have covered that in the intro. But great. I mean, this is a great visualization. This is showing the different international or non-U.S. indexes, U.S. as well, global indexes relative to the world index in the middle. So this is the U.S. basically rotating southwest, and these are a number of non-U.S. markets kind of rotating up and to the right. SSEC, I want to say, is Shanghai, right? That's the China index.
Yeah.
So I'd love to know if any of you have a strong opinion on what we've seen. This is EM showing in red, EM breaking to new swing highs, while most other regions have been unable to do so. How do we think about something like China? There are a couple different ways we can do it. I'm bringing up the FXI here, which is one of the more liquid Chinese ETFs, and obviously the huge gap higher, and now it's retraced a little bit. Anyone have strong opinions on what we look at for the rest of the year, or what we would look at going forward here in a market that, while the S&P is kind of teasing a breakout, China has broken out and now has kind of come back to earth a little bit?
Something I've been looking at is we have a model here at Asbury, and it looks at 24 different countries versus the S&P 500 in 3 different time frames. I'm actually looking at it now. You can't see it on the screen. But just within the past couple of weeks, we went from the spider basically outperforming the world to our model is turning green. You're seeing all these Italy, Malaysia, Spain, France, Taiwan, Brazil, Eurozone, India, and emerging markets. So that was interesting to me. So I was thinking about it. And I actually went on the WHO's website, the World Health Organization's website, and looked at all of the countries that were having fewer cases of COVID. And it was all these same names, these very names, the countries where, the new cases of COVID were shrinking the most were all of these names. So it was just an interesting kind of little nuance that I saw. I was trying to figure out why, after the spiders have been outperforming seemingly for months and months, all of a sudden my screen is lighting up in all these places around the world. And it appears, they're doing what they're doing, but it appears that new cases in COVID might be pulling some of that investment money out of the US and looking towards those countries that are having fewer cases.
Interesting. This is the relative chart of the S&P versus ACWI. So it's sort of S&P versus everything, all global stocks. And you see the relative strength of the U.S. versus everything has kind of rolled over since, mid to late May. Greg, I'd love to pivot back to you. You talked about copper, and it's such a great long-term take. A lot of people have been talking about gold prices, and when I'm looking at tons of charts every week, the chart of gold just strikes me as one that continues to go up and to the right. I know in Canada, gold is a much bigger part of the benchmark, much bigger part of your thought process. In the US, it's a pretty small part. And I think a lot of people, unfortunately, don't look at enough gold stocks, which in some ways have been, pretty resilient on a relative basis. What do you see for gold going forward here for the next couple months?
Well, I still like the gold trade going forward. I really like the gold stocks. I will say on that RRG chart that Julius had, or that you had for Julius, up in the top right there, not this one, but the other one with the international markets.
Yep.
Brazil, Russia, Australia, and third world countries are typically commodity centric. And so a lot of those are right up near the top. And I'm finding a big move into commodities coming across the board. The US dollar on a monthly chart, monthly line chart, is literally sitting on a 10 or 12 year monthly line chart right here, right now, this week.
Wow.
So watching that in a big way to see if the US dollar is finally going to break down. So if you could just pop that out to whatever, put up 15 years or something, we need the 2011 low.
Yep.
But the point on there is, materials topped in 2011 when the US dollar bottomed, and now that US dollar bottom, the trend line isn't quite as clear with the bar chart, but with the line chart, doesn't matter. It gets the same point across.
Sure.
If this trend line breaks, I think that's a big breakout for commodities, and you can see the US PPO rolling over right here, right near the zero level. That is so bullish. I want to be a buyer of all commodities if the dollar's going to start rotating down. And this fact that it had no real momentum for the last wave up here is probably one of the bigger clues for me. So I'm actually expecting a global breakout in commodities, and gold is a big part of that. Gold leads, I think, oil by 18 or 20 months if you follow Tom McClelland's work, another writer on Top Advisors Corner. I like the whole space, especially if this dollar chart ends up breaking down in the next month.
Interesting, sort of that weaker dollar, stronger commodities, and then certainly stronger EM would be a logical extension of that for sure. It makes sense, and I think that's following the charts pretty well. I'd love to go back to Grayson, if I could. You talked about, I mean, your chart was talking about leadership and looking at biotechs, looking at semiconductors and online retail. No doubt those have been fantastic groups. What about some of the other groups and things that come to mind are things like consumer staples, right? Like Kraft Heinz or something that all of a sudden, if you didn't know if it was Kraft Heinz, you think this is a really decent chart that's starting to break out. So what about breakouts in areas like staples, in industrials, in financials even? What utilities, for example, has been one of the top groups this week. Are you seeing opportunities in those kind of traditional defensive sectors, and how does that fit into your overall sort of worldview here?
I am, yeah. I've been watching materials because that's actually when we look at the scooter rankings on the S&P sectors, materials actually have rocketed higher in the last couple of weeks to the #2 spot. The only one that leads them is technology. So, I mean, I think there are opportunities if you're watching the charts. There are definitely, strengthening stocks in some of those more defensive groups. As far as staples specifically, one of the ratios that I love to watch is, as well as a lot of other contributors on stock charts, that offense versus defense ratio, where we can chart XLY versus XLP, which is discretionary versus staples. It's starting to roll over a little bit, but that's a ratio that has been breaking multi-year downtrends and going just wild to the upside, until the last week or so. So, I think there are opportunities within some more defensive spaces like staples, but again, I'm still seeing some of these ratios like XLY versus XLP just clearly favoring offense. So, when I see that ratio going higher, the group that I'm going to look at more closely is discretionary. So.
It's a great take, and I've looked at this, with my viewers for a while, looking at the relative performance of consumer discretionary. Now, obviously, a lot of this is Amazon, right, being a huge weight in the numerator, being a huge weight in the XLY. That rolling over along with some others has certainly caused it to turn a little bit, but overall, I mean, it's continued to favor it until that pivots, right? I mean, if you're given the choice of one versus the other, I get it. Lean into to what's working, guys. I selfishly want to ask you my own questions for the whole show, but I do need to cede the floor to our viewers who have asked some fantastic questions so far. And folks, we're going to get to as many of these as we can. I really appreciate you sending some of these questions in here. Let's start with Greg, if we could, and just and I'll start with you, but then obviously anyone comment if you want. What about the copper to gold ratio? You talked about copper being, and where it is in its tell for the long-term trend. You talked about gold and the resilience there. Do you look at the copper gold ratio, and what does that tell you?
I look at that copper gold ratio. I look at the gold and oil ratio. All of those ratios are trying to express the same thing. And the copper gold ratio has done a good job of kind of emphasizing, I don't know if you can just add the word gold on the back of the copper up at the top, and we'll just see what happens here on that chart.
I'm using your chart here, so let's see what happens.
Actually, dollar gold.
Sorry, yep, hold on.
So, because otherwise you'll have it compared to Barrick gold. Yeah. So, perfect. So on this chart, what you see here is this upswing where copper's starting to outperform. And again, it's not that I think gold isn't going to perform. I actually think copper is going to outperform significantly more than gold, but gold is still going to go up. And I think we're in a situation where we're much more like the 2002, 2003 breakout of commodities starting to move higher. We've been in a big bear market really since the 2008 highs. In oil at 147. So we've been working our way lower on all of the commodities for years, and the CRB recently made a big low. So I'm expecting all of these ratios to start to revert. I'd love to see this copper gold ratio break out above. And this one also follows the 10-year chart quite closely, the dollar TNX. So I think the biggest move that we're going to see is this move in a change of energy, and that change from, I'll call it liquid energy to electric energy, is going to be massive, and there's a whole bunch of stuff in the basic raw materials, copper, gold, all of those things starting to break to the upside to support that trade.
It's a great take. I don't know if anyone has anything to add, but I do want to go to another chart here real quick. Someone had asked about, none of us mentioned the VIX. We mentioned sentiment, but we didn't go to the VIX yet. The VIX is the elevated VIX. It's been above, I remember learning that VIX above 20 means we're in a volatile market. I feel like we're in a completely different range now with, spiking up to 80 plus, but we've come down so much, but we're still above what I was taught was sort of the volatile range. What do you guys make of the VIX here? How are any of you looking at this relative to other charts we've talked about, and what's the takeaway here with elevated volatility?
I can start if you like.
Please, John.
I look at the VIX in a little different way. Again, the VIX is a tactical tool for us here. And so we look at it through a 21-day lens. I'm actually looking at another chart here, but the VIX dropped underneath its 21-day moving average on June the 30th. And that was just a couple of days right before the S&P 500 started to make its move to the top of the range, which is where it finished last week. So that's the 21-day in the VIX right now is 30.27 through the end of the day on Friday. So that's just how we use the VIX as a tactical tool to tell us if we should be a little bit more risk on, willing to put more money in the market, or if we should be pulling our horns in.
Good take. So I updated the chart here. So we're looking at a daily VIX with the 21-day moving average. And I think, John, what you were saying is that, and which I love this because it's less about the range, but more about where it is relative to that average. So the fact that it swung below that 21-day moving average suggests more risk on versus risk off until that would revert up. Is that right?
Yeah, it basically contextualizes the VIX within 21 days. So there's a giant swing in the VIX there. But by making it a little more bite-sized, I think you make it a little bit more germane to what's going on right now.
Interesting. Great takes here. I'm going very quickly through as many of these as I can think about. Right. We didn't talk about real estate at all. Thanks for this question. Interested in the panel's opinion on REITs in a low interest rate environment. We haven't talked about interest rates either as well. Real estate is one of those groups that spun off of financials a number of years ago. And I think until then, people have just thought of it as a non-event, but I think when it became a sector, you had to start thinking of it a little bit. Anyone have a take on real estate? Is that an area you should be looking at with low interest rates? REITs, obviously, in general, tend to pay a pretty meaty dividend. Should we be looking at REITs here?
I look at REITs and in both the sector RRG and in the asset allocation RRG, and to be honest, I'm not super happy with that. If you look at, here it is inside lagging, picking up a little bit of momentum, but it's still losing on the relative strength scale versus the S&P 500. And if you bring up the asset allocation RRG, where we look at various asset classes versus, I use VBINX, which is a balanced index fund. So that's a 60-40 balanced portfolio. There you'll find VNQ, which is a Vanguard REIT fund, ETF, inside improving, but you see that it is already rolling over. And that type of tails, that type of rotation usually doesn't bode well. That there is way too not enough momentum to bring it all the way back. So I'm going to assume that this is rolling over and going back into lagging and will underperform a balanced portfolio, and then by default stocks and both bonds.
I'd be concerned about the group overall. I think that the real estate industry as a whole is facing such an unusual moment right now with the complete destruction of all demand for real estate, specifically commercial. So I think it's a challenging space overall, but there have been pockets of it. Like we've seen, one of the stocks I've been following for a while is Equinix. The ticker's EQIX, and it's a REIT, but it's specifically a cloud computing. They build data centers, that kind of thing. Incredibly strong chart. I mean, just a beautiful trend on this. So, I think there are pockets within there if you want to get a little more specific in your replays. But the group as a whole, I mean, I think this is such a challenging, just with COVID and all the stuff that's going on, I think it's such a challenging environment. Outside of the interest rate discussions and things, I mean, this is a climate that we haven't really faced ever. I mean, no demand for commercial real estate. We're seeing that here in Seattle, for example, with, Amazon saying they're not going back to the office until January 8th, and they're, basically giving up on all these big real estate projects they had throughout the city. I mean, that's a difficult environment. That's not really something that I want to be a part of.
Yeah, sort of the unintended consequences that are going to be coming out for a while.
And I don't know if we have time, Dave, but if you can bring up, there is in the drop down on RRG, there is a predefined group which will show you all the members of XLRE versus XLRE. And then you can see that you can immediately see the split to what is good and what is bad. I mean, you see that cluster in orange and you see the cluster in blue. And you can just basically pick the ones that are close to moving over into the leading quadrant. Those would be the ones that I would be looking at if I was going to look for, very specific REITs inside very, pockets of strength inside that sector. That's right.
That's a great chart, Julius.
It's a really good chart. It's funny, when I was learning this whole investment thing, I mean, talking with REIT guys, you sort of thought of REITs as one thing. It's like, are you overweight or underweight real estate? And that could be like a sector rotation decision. But I think what we're finding now is there's actually some dispersion between different pockets, right? There's commercial REITs, they're REITs that have exposure to different parts of the market, and you're starting to see some differentiation that we might not have maybe recognized as much historically. That's a great point. Next question. We're getting some questions about biotechs. A lot of questions about biotechs, to be honest with you, in the leadership of it. And I think I'll adapt. If I could summarize all the questions I've gotten into one question, it would be this. What do you do with a group that has rallied so significantly? I think we've faced this with biotechs, but you've faced this with the FANG stocks that obviously have reverted lower over the last week for sure. But in a group like this, does this concern you when something has appreciated so much? From a technical perspective, what do you use to differentiate between the things that have rallied that have a lot further upside, and the things that have rallied too much that you have to be worried about potential downside risk? How do you balance those two? Anyone want to take that?
I can jump in there really quick, just because I had biotech earlier. There's a technician that I follow that I love, Ian McMillan, and he posted a chart a little while ago that was basically asking the question: is this a chart that's gone up 45% in 3 months, or is this a chart that's gone nowhere for 2 years? And you basically have the same thing here with IBB. I love that chart that you got, Dave. Especially because you're looking back over 2 years. I mean, this is a group that's pretty much gone nowhere for a year and a half. And so, yeah, we've seen some strength, and we've seen especially some strength out of the lows from the end of March. But when I'm looking at that group overall, I mean, this isn't a major rally off the lows. Overall, it's also kind of a rally off of a big base. So, I think you gotta look at it a little more holistically. If that's your time frame, drag that time frame out a little longer. And I think with some of these groups, especially with biotech overall, you can see that this is kind of outperformance that's starting. It's not necessarily a huge run like we've seen for many years, like in the FANG stocks. So I think you got to sort of take that view.
You're hitting on a really good point. I think a lot of people are focusing on this and just the vertical nature of what's just happened, as opposed to looking at the longer term, which, again, knowing all of you and your work pretty well, it's what I value about you guys is that you tend to do a good job of putting things in a proper perspective. I think that's a great point. One question we had in particular with commodities, and Greg, this was aimed at you if we could. You talked about copper, we talked about gold. Certainly you seem bullish on the space, which I think for good technical reasons. What ETFs would you use to gain exposure to that? If you buy into that strong commodity theme, any particular ideas or general approaches to using ETFs to get exposure to that space?
Yeah, for the gold space, you're going to use GDX. That's probably the easiest one, and it's nice and liquid.
Yeah.
So that one's really a nice chart breaking out to the upside, starting to outperform gold. It's you could use SIL for the silver miners. That one's I mean, silver's just breaking out, so you'd be jumping in on board here with a nice positive start, and then you have the copper miners. CPER is the copper, and COPX is the copper miners, and you can see that copper price chart breakout. So that's another example, but you could play URA for uranium. You could play TAN and FAN for the renewable energy plays. Lithium, LIT, REMX, REMX, all of those are just starting to light up. I mean, these charts are beautiful. So, you know, try to keep the big picture in mind here. If we're going to electric cars, all of these things are going to run big.
Great. Hey, I'm impressed that you can come up with tickers that quickly. That's actually very impressive. Well done. But way to know the space. That's fantastic. You know, we didn't you know, we've had some questions about the Fed, and this is a question I've gotten a lot recently. Just, you know, anytime and Tony Dwyer comes to mind, he was on my show recently, and, you know, when I talk with Tony, he talks about just the supply and demand of money in the system and just what it means. And his comments are things like, when the Fed is doing what it's doing here, you know, obviously we all know don't fight the Fed, but we're at an unprecedented level of support for the markets. How do you guys think, or how do you reconcile what you're seeing on the charts with things like that? Overall headwinds or tailwinds, like you know, the tailwind effect of the Fed that has basically said it's going to do whatever it needs to you know, to push stocks higher. How do you relate that to what you're seeing on the charts? Anyone want to take that?
I'll let the chart do the talking.
Yeah, I was just going to go there. I just did a rather large web presentation to a large group of investors, and questions came in at the end, and most of the questions were, what's going to happen with COVID, or who's going to win the election? We don't know, and it's like multi-dimensional chess. Even if you get the candidate right, or even if you get the COVID right, you don't know how the market's going to react to it. So I think a lot of investors focus on solving those little mysteries and thinking that's the key. As far as I'm concerned, you know, we're totally data-driven here, and I'm sure all of you guys are too. That stuff will show up on what we're looking at the appropriate time. We don't have to have those answers. We could watch money moving in and out of the market. We could watch volume. We could watch corporate bond spreads to get a sense of what the bond market is thinking of the overall environment. So that's nice to talk about it around the water cooler, but in terms of investing, I think you need to have an approach that is robust enough that it will see all these potholes coming up as they come and give you time to react to them.
I love that take, John. That was fantastic, and I think and Julius as well. You guys both, you hit on how I would answer, which is basically the price should reflect all of that, right? It reflects where investors are at and what they're thinking, regardless of the driver that's pushing it higher. We have time for one final question, and then we're going to wrap up and go to into the lightning round. In particular, let's see. Oh, you know, so one of the things people had mentioned is about behavioral metrics. How do you reconcile the technical, what you're seeing here, with the fundamental, with the behavioral, right? With your ability to make decisions, with the fundamental stories. Anyone have any comments about, or words of wisdom on how, especially now, given so many different uncertainties, so many different inputs, how are you incorporating the charts relative to some of those other inputs, like you know, fundamentals about the particular company you're looking at, but also behaviorally, right? How you're making decisions, or the sentiment, the fear and greed that you see around you. Anyone want to have an insight on that?
It's Greg here. If I was to pick up the sentiment, everybody expects the market to go down here. And there was a really good quote, and I wish I could come to mind with who had said it, but it was basically, once the market has determined the direction and everybody's on board, that's probably the end of the trend. As long as there's a lot of pessimism, the trend can continue. And I would agree with that. I think the second biggest component is, you know, I had somebody saying they were going to short the S&P, and I'm like, 97% of the groups are going higher. That's hard work. You're just wait until you get a signal that something's starting to weaken. Just give something a chance to weaken. But the big thing is price is moving higher, momentum is moving higher. It doesn't matter what group, like this basic materials is just starting to break out. It could be the next leg for tech for 40%. We just don't know, but we just got semiconductors breaking out, basic materials. I think it's a big opportunity to stay long.
Yeah, and also what you're saying, I mean, everybody, there's a lot of arguments for the market to go lower. There's a lot of talk about markets going lower. A lot of people are talking about markets going lower. But what I've always learned is that everybody talks to their own position. So all these people who are talking that the market is going down have already sold. They are not in the market anymore. And if the market is not going down, but it's going up, they need to come back. So all these people who are now talking about the market going lower are our buyers to push it higher because they don't have a position anymore. And when the market goes, they need to jump on board of that bandwagon.
That's a great point. I think going back, John, to probably your, you mentioned a couple times sort of that 3230, 3250, that resistance on the S&P. Arguably, we get above there, and that's where, maybe some people start to feel that pain and feel like they need to get in there. Folks, we're at the end of this. This is awesome, and I wish we could keep going with questions because we've had so many questions. I picked some of the ones that I thought we could get to, but I want to wrap this up with a lightning round if we could. So as I asked all the panelists, I'm going to hit you with 4 questions. I'll start, and I'm just going to go down the list of how I have you. I'd love for you to just briefly answer it, 5 to 10 seconds most, but what we're going to do is just try to capture some quick insights on what everyone's thinking here. Question number 1, this is actually a question we asked as a poll question on StockCharts TV in the last couple weeks. What happens first this year? Choice A, the S&P breaks above 3,400, which would be a new high for the year. Letter B, the S&P breaks below 2,800, which would take it to a new swing low below the 200-day moving average, et cetera. Or option 3, neither of the above happen through the end of 2020. I'll start, John Kosar, with you. A, B, or C, what do you see happening here?
I think it's A. I think we're going to get up to that 3,400 area, maybe break it. I wouldn't want to buy the market and go away for 6 months where I couldn't see a screen, but I think the first place it's going to test is at 3,400.
Perfect. Julius, A, B, or C, what do you see?
A. I don't have the guts to go against it, so it's got to be above 3,400.
All right. Greg Schnell, A, B, or C, what do you see here?
3,400 or higher, the momentum is all up.
Grayson, is it at 4 for 4? Grayson Roze, A, B, or C, what do you see
I don't want
here?
to make it 4 to 4, but I think we bounce around maybe, between here and 3,000 a little bit more, but then I think we go to 3,400 before we go to 28. So yeah, I'm going to say A, maybe C.
Grayson reserves the right to put a little on the side and say none, but I'll call that an even 4 for 4 with the first option, assuming the S&P can break above 3,400. Fair enough. Question number 2, what's the top performing asset for the remainder of 2020? You have 4 choices: U.S. stocks, international stocks, bonds, or gold. So think of it in ETF terms. U.S. stocks would say the SPY, international stocks say EFA, EFA. For bonds, you could say AG or TLT, one of those sort of conglomerate ETFs. And then for gold, the GLD. So we'll start, John, with you. Which of those 4 do you see as being the top performer for the rest of the year?
I'm going to say gold. It's a safer play maybe, but I'm a little concerned about the stock market being able to keep the mojo through the end of the year. I like the flows that are going into GLD. I think it's a safe, you're going into an election. There's a lot of turmoil around. So to me, if I had to pick one, it's maybe a slower horse than stocks, but I think the safe bet here between now and the end of the year is probably gold.
Okay, 1 vote for gold. Mr. de Kempenaer, which of those 4 do you see top performer?
It's a close call. All 4 look pretty good, but I'm going to go with international stocks. I do think the US will do very well, but I'm not sure whether it's going to be all the way through the end. So for this, I'm going to go with international stocks.
International stocks. Greg Schnell, which of those 4?
I'm going to take international stocks, and the main reason is because I'm a big believer in the commodities overall. So I think the commodities are going to rock, and that's going to lift world markets in terms of not only the commodity countries, but the emerging markets. So I'm expecting big things.
Grayson Roze, which of those four do you think top performer?
Yeah, I'm with Greg and Julius. I think the strength in stuff like copper is going to help lift emerging markets. I'm going to go with international stocks, but I think it is going to be close between U.S. and international.
So it's interesting, all four of you saying market going higher. None of you picking U.S. stocks to be the top performer, though, which I don't disagree from a technical perspective. I can see what you're saying. We have time for one more lightning round question. Go very, very quickly if we could. Top sector, your best overweight for the remainder of 2020. So out of the 11 S&P sectors, what would be your top pick for the rest of the year? We'll start, John, with you.
I'm going to give two. One of the models we have actually measures asset flows going into all the 11 sector spiders, and it measures them relative to each other and relative to the whole group. And the two that, on a strategic basis, that are doing the best right now are tech and industrials. And if you held a gun to my head and I had to pick one, it would be tech. I think the way that society is going now with COVID, more people are working from home. It's more important to have technology than it ever has. So just for that reason, I think I would choose tech.
Okay, one vote for tech. Julius, which of the 11 sectors do you think?
Materials, XLB, just moved into leading. I need to go with that. The other ones are rolling over.
Perfect. Greg Schnell.
Hey, Julius has been following my charts. No, I'm a materials guy for sure. Absolutely. Commodities.
Okay. Grayson, which of the 11 sectors do you see?
I do like the materials trade, but I do think that we're in a tech-driven world right now with everyone, still shut in and needing to do stuff like this. I mean, this meeting's happening because of technology, so I still think tech goes higher.
2 votes for tech, 2 votes for materials. All right, we'll take it. Hey guys, this has been such a pleasure. Thank you so much for giving us some time on a Saturday to let us pick your brains a little bit. And on behalf of all the viewers, really appreciate all that you've done for StockCharts and StockCharts TV, but especially for giving us some time on a Saturday here to share your perspectives on the big picture. So John Kosar from Asbury Research, Julius de Kempenaer from RRG Research, Greg Schnell of GregSchnell.com, Grayson Roze from StockCharts.com. Thank you all so much. Stay safe, and we'll look forward to hearing again from you soon. Hey, everyone from Redmond, Washington, the headquarters of StockCharts.com. Thanks so much for joining us. Wish you well, and we'll see you next week on StockCharts TV. Be well.
Hey, Grayson Roze here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.